the price of Bitcoin isn't necessarily set only by spot, right? If I have a Bitcoin and I sell it to you, we agree on a price and we sell and we exchange it, but that's a very small portion of the overall activity of trading, which is now dominated by futures. The chart that scares me the most, Austin, is the picture of gold volatility right before the Weimar devaluation. So it's not the movement of the price per se, but it's the change in volatility from a regime of stable, still volatile, but stable, to unstable. And that's when fear, panic happens and things can turn ugly really quickly. If you look at those, the consensus believes that US equities, broadly speaking, are going to do well, and that the Mag 7, particularly the AI companies within Mag 7, are going to do better. To me, the surprise this year would be that that's not the case, and that some of the areas within tech, software, for example, are getting beat up pretty badly. A year ago, if you would have told people that hard drive companies were going to be some of the best performers, people would have laughed at you. But the reality is, if you had the vision to say, all those stupid cat videos that are all over the internet, they got to be stored somewhere, which means some big hard drive somewhere. So that turned out to be a really big thing.
Mark Yusko opens with a statement that has made him unpopular in recent months. We are in crypto winter, not a temporary chill, not a routine pullback, but a structural cooling period that follows every parabolic cycle. For Yusko, denial of this reality is precisely what prolongs pain. Markets do not move in straight lines, and they do not permanently abandon their cyclical nature simply because new participants arrive. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
Yeah, we're in crypto winter. Everyone hates me because I keep talking about it. People are familiar with the banana zone, right? Which is, technical analysts look at these rising parabolic moves and they kind of look like a banana, and then they correct, and then you get another banana. Okay, fine. And there's a guy who said, no more bananas, right? We're not going to get any more parabolic moves. We're now in the cucumber. So it's just going to be this steady ascent, number go up. I'm like, well, why? He's like, well, the institutions are here and they're just going to buy up all the supply. I'm like, okay. And on the surface, that math is true, right? The institutions, the ETFs and the institutional buyers did last year buy 4 times more than the amount of Bitcoin that was mined. True fact. But somehow the price went down. How? Because some people who've been holding for a very long time also sold. Well, why would they sell? Well, lots of different reasons, but the bottom line is it wasn't even that. The price of Bitcoin isn't necessarily set only by spot, right? If I have a Bitcoin and I sell it to you, we agree on a price and we sell and we exchange it, but that's a very small portion of the overall activity of trading, which is now dominated by futures. And look, this was intentional. This is not new. It has been going on for decades. It's the reason that Bitcoin and Ethereum in particular were deemed commodities, not securities. Everybody's like, oh, yay for us. They're not securities. Like, no, stop. That's not what you want. You would have much rather them be a security and regulated by the SEC and not had this crazy futures market. Once you have a commodity, then this bad thing can happen, which is in the old days of commodities, right? I'm a cow farmer, you're a pig farmer. We meet at the market and we want some of the others. So we literally swap a physical cow for a physical pig. Great. Okay. Analog. That was inconvenient, right? So you leave your pigs back at the farm. I leave my cows back at the farm, and we stamp out some coins. Yours have little pigs on them. Mine have little cows on them. And we exchange the coins. But the problem with that is carrying around that sack of coins, the banditos can come steal our coins, and that's less good. So we put our coins in the bank, and now we write a contract that I'll give you 2 pigs for 3 cows or whatever. But we still, on the farm, had to have the physical item. Oil then happens. So someone discovers oil. In the old days, if I wanted to sell you a barrel of oil, I actually had to have a well so I could produce a barrel of oil to sell to you. Well, then this financial engineer came along and said, well, yeah, that's great. But Mark, you could just write a contract for a future barrel of oil. But I don't have enough oil in the well to, don't worry about it. As long as you settle up the contract before it's due, you don't ever have to come up with the oil. Huh. Okay, so I can create oil out of thin air. Magic. So everyone starts doing this. And every time you get one of these parabolic banana zone moves, what you'll notice is there's 3, 4, 5 paper somethings, barrels of oil, bricks of gold, ingots of silver, bushels of wheat, whatever it is. Commodity markets can be manipulated. Well, then it gets even more dastardly because, well, what if I wanted to manipulate the price? I could just sell a barrel of oil and put downward pressure on the price. Because then if I wanted to go buy some real stuff, I could buy it at a lower price. And this is the oldest secret in the book on Wall Street, right?
Crypto winters are psychologically brutal. After a sharp drop, prices stabilize briefly. Optimism returns. Market participants declare a bottom. Then another sharp leg lower arrives. Yusko emphasizes that bottoms are processes, not events. They are characterized by declining volatility, declining volume, and emotional exhaustion. What many mistake for accumulation is often simply a pause in forced selling.
We have a lot of people talking about, lots of different things. If you ask 10 people, you get 11 opinions. But I think what keeps happening is, you get a sharp drop and then you get some stabilization. People, oh, see, that's the bottom. And now we're going straight back up. Like, well, based on what? And then you get another sharp drop. And it's these, I'll just use Bitcoin as the reference, but you get a $5,000 move in Bitcoin in a few minutes. That's disconcerting because it raises questions like, where's all the liquidity? Why? But you flip over into the traditional markets, TradFi markets, you got stocks that gapped 10, 12, 15, 20% today, right? So there's definitely uncertainty, about valuations, about liquidity. And then the other thing that is related, but not exactly related, is what's happening in the metals markets, right? You had these just parabolic moves up to end last year and the beginning of this year. And, everybody's talking about different things. But then you had this massive correction starting last Friday. And, people say, oh, they wiped out $9 trillion in 3 days. Well, kind of, but that 9 trillion never existed, right? I mean, if you tried to sell all that gold and silver at those high prices, you never would have got it. And the minute someone tried to sell even a little bit, those prices collapsed. Some would argue they were manipulated down, whatever. But then they bounced back up yesterday. The chart that scares me the most, Austin, is the picture of gold volatility right before the Weimar devaluation. So it's not the movement of the price per se, but it's the change in volatility from a regime of stable, still volatile, but stable to unstable. And that's when fear, panic happens and things can turn ugly really quickly. So what you do is I spend 3 weeks, 4 weeks gathering the consensus for every asset, from stocks to bonds to real estate to commodities to digital assets to China to Europe to, Middle East, whatever. And then once you have the consensus, that's what everybody thinks, and that's mostly in the price. So let's say everybody thinks stocks are going to go up 8%, which is the consensus every single year. I mean, it's like lockstep. Well, that's not going to happen. In fact, never, like the average return on equities is 10.5% compounded per year. We've never actually had 10.5%. Like in 140 years, it's never actually been that because it's always more or less. And so the same thing happens here. When everyone assumes something, it's rarely spot on, but directionally, it's right about half the time. So the idea of a surprise is let's form the opposite of the consensus. If you get that right, you can probably do better than average. So I'll give you an example. So last year in 2025, back in January, I did my, and I always do 11. I do 10 plus a bonus surprise. And the surprises went 6 and 5 for the year. 6 were quote unquote right. 5 were wrong, meaning the consensus was right. Now, what's interesting, if you had just bought the market, last year was a really good year. Market went up 18%, US markets. If you had bought an equal weighted portfolio of the 11 surprises, you went up 32%, which is better. Now, well, how? Like you were wrong half the time. And the ones you were wrong, we were really wrong. Like, we thought markets would go down. We thought the economy would recess. So basically a short on the market. Well, the things we got right, like gold, for example, went up a lot. And half of our surprise was not just the gold itself, but the gold miners, because they were super cheap and they went up 160%. So, Soros had this great line. It's not whether you're right or wrong in markets. It's how much money you make when you're right and how much you lose when you're wrong. If you look at those, the consensus believes that, US equities, broadly speaking, are going to do well, and that the Mag 7, particularly the AI companies within Mag 7, are going to do better. To me, the surprise this year would be that that's not the case, and that some of the areas within tech, software, for example, are getting beat up pretty badly. And just about every day, Oracle, CRM, all these big software companies, ServiceNow, are just shedding market cap. Now, the flip side of that is, well, then every day, the AI companies should be going up. Well, they were all last year, but now they've kind of been rolling over. So I look at the big uglies, as I affectionately refer to them, the Microsofts and the Googles and the Metas and, the big companies at the center of all this. I just think the valuations finally kind of caught up to them. And there's certainly a couple places that will continue to do well in tech. But again, I think so much of it's already in the price. So memory is one, right? So SanDisk, everybody saw it up 750% last year, and it's up, 160% again this year. Every day seems to go limit up. I haven't seen it today, but SanDisk is a great example of a business that, wasn't even a standalone business until middle of last year when it got spun out of Western Digital. And a year ago, if you would have told people that hard drive companies were going to be some of the best performers, people would have laughed at you. But the reality is, if you had the vision to say, all those stupid cat videos that are all over the internet, they got to be stored somewhere. which means some big hard drive somewhere. So that turned out to be a really big thing.
Mark Yusko's message is not pessimistic. It is disciplined. Crypto winter is not a failure of the thesis. It is the cost of financialization. Futures markets, leverage, and institutional participation change the structure of price discovery. Cycles remain intact. Parabolas still exist. They are simply obscured by paper markets that stretch time and amplify pain.